Hi everyone. Hi everyone. Welcome to our new market talk today. We have two new people joining us, Matteo and Andrea. You will meet them later today. So interesting week so far. We're gonna address what we see in stocks, indexes, bonds, etc. Why don't we start with Bryan?
Hey, how y'all doing? Doing well. Okay. Yeah. So last 2 weeks ago, I was pretty much talking about how I was as bearish as I possibly could be, and that's been pretty good. S&P's been down for 2 weeks in a row. It's been pretty profitable, and broadly, I'm still super bearish. Like nothing's really changed, just besides the fact that bonds have gotten even more blown up and all the data's come out to confirm all the reasons why I was bearish. So what I'm looking at now, I'll share my screen here. All right. All right, y'all can see that okay, I think. So where we were at, if I just pull up a chart here. Reminder for everybody, this February 2nd, 2223, that was bear capitulation day. Dollar bottomed that day, bond yields bottomed that day, gold topped that day, stocks, Russell, NASDAQ, and S&P all topped on that day. And since then, bears have been controlled. People were complaining about how it's hard to be short here, hard to be long here. Broadly, it's been pretty good just to have shorted all the way back then and hold it till now. The biggest thing that was a signal for the capitulation was bond yields. And so those have been absolutely destroyed. Everyone was positioned on February 2nd and then really laid into it on capitulation day for cuts to happen in the second half of the year. And the following, right after that day, we had the NFP report that was hot. We've had ISM reports and PMIs that have all been hot. Inflation's warm and sticky. It's going nowhere, and the Fed is having to hike. You're now seeing a bid for potential for 50 basis points here at the next meeting. If that keeps bidding, that's just going to pressure stocks further. And I think it's possible that they upshift, or at least they have to be hawkish. And the data coming out here after the ISM manufacturing today showed prices paid up for the third report in a row. You got ISM services on Friday. That's going to show prices up again, likely, and broadly just sticky inflation. So there's no reason to be long bonds here. Bonds are getting absolutely destroyed. The trend signals are pretty weak. So if we look at IEF pulling from MFR here, it's been bearish trend for a while. It transitioned pretty early. I'm getting a little bit of an oversold signal, but I'm not too worried about it because there's really no catalyst for yields to drop right now. I mean, like bulls, I can't find a bullish catalyst that's going to pressure yields and hold the dollar down. That can get anything going for bonds. And so definitely wouldn't be long. And I'm still short via BNDX. I'm short European bonds. I'm also short or long PFIX is my best way to express that. If you look at correlations between IEF and UP, this one's actually softened a little bit recently, but it's broadly been holding a negative correlation. And I expect if the dollar bounces tomorrow on claims and then Friday ISM services, you're going to see IEF UP go negative again and strengthen that negative correlation. And dollar up, bonds down, dollar up, stocks down too. So I expect that one to soften a little bit, strengthen. And then so where we're at now, I am getting the potential for us to have a short-term bounce, and this chop does make sense that it's happening, but I think that we could puke. We just need something to trigger here. So where we're at in the gamma structure, if I look at the SPY gamma structure right here, we're now in like very heavy put dominated territory. So 400 was absolute gamma and gamma flip through all of these attempts higher on stocks. If I pull up again the S&P, I look at SPY just because of kind of where my signals are plugged into there. Like 400, we've broadly been staying. We tested a little bit above, but that's been the cap for this entire chop. And that one is gamma flip as well as absolute gamma. So all attempts higher from there have failed. And now today we have broken down below 395, which puts us in like a very dense, heavy put dominated territory right now. So if we get VIX to get off the freaking mat and get vol to bid, you're going to look at a very swift move down to 390. And then if we can get correlations to strengthen into that move, I think we could puke below. Looking at vol, I mean, it's just a matter of time. Every single freaking day, like the most I've seen SPY looking at like fixed strike vol for IB rank, this is like the most this one's gone to in any of our attempts lower is like 35%. Like vol has stayed in the bottom third of where it's been for this entire bear market for all attempts lower. Even when it was getting a little hairy and VIX was bidding a little harder, like vol is still very cheap. And anytime it goes lower, it went down to 25% on SPY yesterday, and IWM went down to below 20%. This one into the close went below 20, like right at 20%. And so vol is still very cheap. It's a beach ball underwater. It'll bid. And now we're in a very vulnerable territory below 395 to where if vol bids, like you're going to get a very fast move in stocks. It could happen overnight. I think overnight we've got not much overnight. We got claims tomorrow. Actually, we get claims tomorrow, and then ISM services, the big one on Friday. So I don't really see any reason that any kind of bounce would be sustained above 400. Even if we do bounce and we get above 395, then your 400 is upside. So you're gonna have to have a couple of days in a row of upside with catalysts, with dollar down and bond yields down to get past 400. So right now, I don't see any kind of sustainable bounce. I could see some more chop or the potential for tomorrow that we break down with sector correlations playing. Right now, we've had low beta significantly underperforming. This is weakened sector correlations, which isn't a great sign. Stock bond correlations were extreme. Those have softened a little bit now. So now we have room for those to re-strengthen positively if yields continue ripping on claims tomorrow and ISM services on Friday. And then I expect if we do break 395 and vol bids here, that we'd have sector correlations pick back up. So the recipe is there for a potential puke. But even if we don't puke, we've got Hurst exponent strengthening pretty aggressively across the board. So just a reminder, Hurst exponent measures basically the probability that if you're down today, you'll be down tomorrow. SPY has a Hurst of 73. We were red today. We have a 73% chance of being red tomorrow on a closing basis. That's the way I read them. So you have SPY and QQQ, Hurst, pretty strong. IWM, I think these long onlys like decided on capitulation day, the February 2nd, that they're just going to passively buy Russell. I mean, you look at the open for 3 days in a row now, rips on the open. Look at what Russell's done the first 15 minutes, rips. These guys are just passively buying crap because a lot of the data we've actually gotten hasn't been recessionary at all. It's actually been reflationary. ISM today showed a pickup in new orders as well as prices up. And so that's, reflation. I think that's not a reason to be bullish, which, reflationary is typically bullish for stocks because earnings have been absolutely terrible. So reflation here just leads us to more hawkishness until growth slows again. And so reflation isn't bullish. And I think once we get back to stagflation, that's when things get really bearish from a macro perspective. I don't quite know when that is, but that's what I'm seeing right now. But Hurst are all strong across bonds, dollar, and stocks. So I expect this down move to stick. And I expect the down move in bonds today to stick as well. If we do reverse, regaining 395 and correlations remain soft, that could lead some kind of bounce. But again, we have to get above 400 for any kind of bounce to stick. And so correlation softening, they were strong. We couldn't break for a couple of days. Today was potential. I think we could potentially see correlation strengthen tomorrow. We'll see. Trends are breaking across the board. I like my target net exposure model here, which measures all my trends and all my tickers. That one keeps going more negative. Hursts are strong, risks are big. I don't like that correlations have softened, and I don't like the high beta still outperforming. This one did close on the lows today, so that's a good sign. I want to see it fail and go red. I'd like to see that tomorrow on correlation strengthening as well as SPYs holding below 395. If we get those three things, I think this down move could really go. in a big way, and VIX could really go. But for now, these high beta bulls just they're not giving up. I don't know why. You look at like Tesla. I mean, I'm short it, but like it's gone nowhere. Like eventually this thing's got to give. And I don't know what the catalyst is for this thing to get going again, besides like dollar down, bond yields down aggressively, but none of the data says that's going to happen. And the signals don't say that's going to really happen either. So, yeah. So, I mean, recapping, about as bearish as I was 2 weeks ago. I'm still very short. I'm not impressed more today, just because I think we could potentially chop a little longer, and we'll have probably a chance to press tomorrow, or we could bounce, but I don't think a bounce is sustainable. So broadly, like it's been pretty easy to be short over the last 2 weeks. I've just been holding really, like, and then I kind of I rotate in some names out, rotate some new ones in as we get closer to their earnings reports. Lowe's today was an absolute disaster. And so there's a lot of opportunity there on the short side, and it's going well. So it's good to kind of come back from January, which is pretty bad, and moving on to a good month now. So yeah, so still very bearish on stocks. I think we're lower in 2 weeks, higher in bond yields, higher in dollar. And that's all I got.
Okay, great. You actually, you nailed the move. I mean, I remember 2 weeks ago, you and Matt were quite bearish, and it proved to be the right move. Now we are going to Matt in the US.
Hello, everyone. I would say that I'm similar to Bryan in that I haven't changed my view, but right now I do think we're going to have a bounce, and I'm looking at Salesforce earnings, and the stock is up 14% after hours. So they beat, and people are going to chase. My core way of making decisions is via technical analysis. I've also started to add some options analysis to it, where I'm calculating ratios and whatnot. Of the 9 ratios that I follow, 5 of the 9 are risk off or neutral. 4 are actually risk off. So things are looking like we're getting to a little bit more in the risk off territory. How VIX is continuing to be suppressed is just mind-boggling to me. I mean, something is just keeping this beach ball underwater. But when it does decide to surface, I think it's going to be an absolute slaughter in the U.S. equities market, no matter what sector, no matter what your belief is. It's going to be just ugly. I don't think it's going to happen immediately. I think we might have to wait until April. I'm going to continue to be bearish. I haven't covered but a few of my short positions. I also, my reasoning for being bearish is continuing to grow because the geopolitical risks seem to be getting higher with every passing day, especially with China and Russia joining hands and the U.S. attempting to stick a fork in that. I think this is getting more and more dangerous, and will be a catalyst. It will be a catalyst for the markets if things can continue to slide downhill. I also feel again that rates are going to continue to move higher. That we're in a structural inflation environment where no matter what the Fed does with their little pitsy 25-point basis rate rises, they're behind the curve in a big way. And with each of these reports that comes out, it completely cements that. So the Fed, in my mind, is completely screwed right now. And the only way they can potentially save credibility is to play catch up with higher rate hikes. Whether they'll do that, I don't know. I think the dark horse out there is still China, because we're seeing that China is pumping liquidity. And if China starts to grow, it will apply more pressure on the inflation side, because we're going to have immense demand for just raw materials and commodities across the board, which will, I think, also affect the oil market. I'm still long oil, a smallish position. I haven't changed. I think it's going to break out to the upside. Could be wrong, but that's where I'm playing. The only concerns I have regarding, I do think we're kind of near a short-term bottom right now. and feel like we're going to bounce. I don't think it's going to be a big bounce. Maybe on S&P, it would take us to 4,000 to 4,050. My biggest concern is that the Russell 2000 is not cooperating right now with the down move and the other indices. And Russell tends to lead, and so that tells me it's a warning sign. It's a red flag. Beyond that, again, still bearish, still short bonds and long volatility. About the only thing I've added in the last 2 weeks would be going out on the duration side for my market puts and VIX calls. I've gone out to September now. And I am also, let's see, today I also placed a put trade in the German ETF, EWG, starting to enter that on the short side because Germany looks like it's about to blow up from the fixed income side. They can't control inflation and rates. If you've looked at the entire duration, the entire curve in German rates, it's just gone through the roof in the last week. So effectively, that's where I sit. I'm still extremely bearish. I do think we'll have a bounce, and I do think that eventually VIX is going to bust out of its cage, and all hell is going to break loose. So that's my 2 cents for the day.
Yeah, I agree with many things that you said, Matt. And certainly Christopher will address Germany later, I would guess. Now let's go to Italy, to Matteo.
Well, first of all, thank you for having me here. It's a pleasure to meet you all. Looking at the markets, I'm basically an equity market player, so my positions are just equities. I'm very short at the moment, very short Nvidia, and it didn't play out so well lately. And looking at the equities, I think that they're basically smoking opium because their valuation are absolutely insane, and basically they are shrugging off everything that's coming out of the news. And it's pretty strange because looking at the other markets, such as FX or the rates, they are going on the opposite direction. I mean, yields, for example, today were up, and the equities were up too, which is strange. I mean, they were not up, but they were strong. And it's just insane that the equities market is basically pricing in as the Fed will likely try to stop or reverse change or similar, because that's not what will gonna happen. So there are 2 things for the next forms that I'm looking for. Either a 50 basis point hike, which should have happened the last time, but it didn't, or a 25 BPS hike with the increase in quantitative tightening, which is something that is very much needed because the liquidity injections from the Treasury and the other countries are basically offsetting the quantitative tightening, and the increase in liquidity is one of the various reasons why the equities are flying this up. So basically, this is what I'm looking for the macro side. Looking at the data, I think that unless we have some kind of catalyst or some very negative data, the market will either continue to chop or slide very slowly grind down. I don't think there is much of momentum to keep it going higher. I think that the momentum basically wore off completely in the last 2 weeks. But there is not enough strength from the sell side at the moment to make it go down massively. So tomorrow we have the jobless data. If the jobless data is very, very hot, I think that could be a catalyst for a short-term puke, but not that puke. And we can just continue to chop around until the next FOMC, which would be very annoying from our side, but I think it's nonetheless a possibility. Looking generally at the equities, especially on the tech side, it's just incredible. We have seen all kinds of narratives taking place just to make things go higher. We have things like Apple that misses the earnings and still goes up 4%. We have all the big tech that had very disappointing results and still going up. We have Nvidia that had revenues going down. I think I remember well 61% year over year and still going up 14% the day after. It's pretty strange from a valuation point of view. We are in back at levels that are even higher than they were in the peak of the bubble at 2021. So I'm really surprised. I'm really surprised. So yeah, that's my point of view. For effects, I think that
We are losing Matteo, no?
I don't think that the bounce for euro will last long. Probably gains the euro today will already be arrived tomorrow because
I'm not receiving his internet well with Matteo. Am I the only one?
No, he's cutting out, Raph.
Okay. Matteo, internet is not working. We cannot hear. Okay. He will access through phone. We're gonna wait for Matteo to come back. So yes, the move in tech has been incredible, especially if you consider that it trades with yields inversely correlated. I mean, they are holding pretty nicely. So
yeah, I mean, Nasdaq's it was only down 1% last month.
Yeah, it's mind blowing. He was talking about Nvidia, and yeah, Nvidia is exactly the same kind of case as Tesla. Basically, it's and nothing is able to take a dent at it. So ultimately, it's gonna work, but yeah, when?
I think it's because, like, if you think about 2/2/23 bear capitulation day, everyone like committed on that day to change their positioning, and so like you got all these late bulls that aren't just gonna flip in a month after it took them 3 months to flip bullish, right? And so I think that's kind of what you're seeing. Like they just, I don't know what. That's why I'm just like, I look at this thing that's like breaking down, like VIX isn't going, and I'm just like, what do you need, Mr. Market? Like, what do you need to break here? I mean, the long end of the curve is blowing up in your face. Like we're already almost back to November highs. And like, it's like, what do stocks need to break? And then you almost think, then you're like, okay, well, the data's been very reflationary. Is that bullish for stocks? But like, no, because they didn't get there based on that data. They got there based on Fed dovishness and disinflation. That's like what got them to the point where they are. And so now that we're getting the exact opposite of that, you'd think they turn, but I don't know. I think they just turn and then they go. And so like, that's why I'm just waiting. I'm just here. I'm gross short, still making money. And I'm just waiting for the huge down days.
Yeah, of course.
Yeah.
Yeah, but in the meantime, I don't know. Shall we go to Andrea and maybe when Matteo comes?
Yeah, I would go to someone else.
Okay, let's go, Andrea.
Yeah, I can go. I hope I'm having problems with connection too, so I hope it doesn't blow up. So basically, for who doesn't know, Spaghettilisbon, you can find me on Twitter. So basically, I'm more of a macro guy. I tend to focus mostly in fixed income, short-term interest rate trading, and some other stuff. I like to trade equities, although in the recent months have been frustrating after paying off last year. In terms of what I'm looking at, mainly have been very bearish on bonds, especially on the European side. I think we are in a structural change. I don't remember who was speaking before, but I think it was Matt saying that we are in a structural shift for inflation. And I tend to completely agree. I think especially Europe is quite under pressure. We went through the winter without any kind of problems with gas or energy or whatever. But the problem persists. I have in my mind that at the end, the Europeans sent out checks to cover cost of firms. So they cannot do it indefinitely. And if they do it, it's a huge fiscal drag that will push up their borrowing costs quite a lot. So from the fundamental view, I tend to be bearish on bonds, without even saying that the ECB will start to do QT, which sounds like a joke, but they are going to do it. But one thing I want to point out is that I have been bearish a lot on bonds. I think Germany is the country, along with France, to be short for two main reasons. The first one is that Germany, of course, is the country that has been hit the most by the Russian invasions. They have structural problems. Their inflation is not going down as fast as everyone hopes. I think the number of today, they confirm it. At the same time, I would say that Germany has been the kind of mispriced country for quite a long time. The bonds has been the sort of safe asset, and with these kind of changes, I'm not so sure that it's going to be the safe asset that it was before. But that's just my two cents. In terms of what I'm kind of watching in markets, I tend to look at different things in terms of signals and so on. I can tell you, well, I cannot share them because it's I have a compliance problem. But in terms of inflation, I compute just a simple index where I try to check where we are in the distribution, and if we have surprises in terms of inflation. I mostly do it for the US, and I can tell you that we are pretty much still like at a level that is like on a standardized basis 2.2 sigma, which it's not the 4 that we had pretty much in the summer last year, but because we came down quite a lot, but still is a place where you don't want to be long bonds. At the same time, in terms of growth, I've been quite positive. I think a lot of people are kind of underestimating how much money has been injected into the system, and the Fed has pretty much done nothing, in my opinion, to reduce that liquidity. We still see Tesla going up, Nvidia going up with no fundamental reasons, so there is still a lot of work to be done. I would say also one thing, then probably I can pass the word to some other guy that has more interesting stuff to say, and it's regarding Europe. I've been kind of Europe focused nowadays, but I've been quite surprised for how well the equity market has been holding up despite rates moving so fast. And this is something I think that it will wait in the upcoming month. As everyone, I think someone before was quoting China, I think was still Matt. And I think that China will be sort of the key driver for Europe and of course for global inflation and growth, because China at the end can be a good source for growth. It can help quite a lot, but it can help also on the inflation side. The battle between the two, I think it will be in inflation, and I won't be surprised to. I still see like the curve. For instance, if you check sulfur pricing, still some kind of cuts in at the end of 23, like 10, 12 basis points, and those basis points do not make any sense. Of course, it relies quite a lot on China, but my main point is that inflation is not going away. I think that we can still play the 2022 kind of scenario for the upcoming weeks. And one thing that I've been playing also is the geopolitical tension. I just want to mention it. I've been playing through it through a long short trade, which is mainly being long essentially worse stocks, while being short stocks like Pfizer, Moderna, and so on. Mainly Pfizer, because at the end, I think COVID is a thing of yesterday. They will have revenues dropping, so I think they are a good candidate for the short side. While on the geopolitical side, I don't think we are. I think the situation can really blow up in a short amount of time, and everyone, I think, is kind of underpricing that risk. So that's my 2 cents, and well, that's pretty much it. It's keep the short boomed.
Yeah, great. I mean, I think Bryan is very happy about hearing what you are saying about European bonds. And yeah, definitely, it seems like everybody is underpricing the fat tail that is geopolitical risk. I mean, it's like the war is over, and China is gonna play a good guy. So we shall see in the next few months. Matteo, we've got you back on.
Yeah, do you hear me now?
Yes, it's working.
Okay, perfect. Italy is great for many things, but internet is not one of them. So one of the things that I was saying is that I'm mainly an equity guy, so I go short and long on the equities based on fundamentals of the companies and the macroeconomic factors that influence the companies by percent. And my biggest position at the moment is Nvidia, which is not playing out so well. I'm currently unhedged for the short. I was hedged until the earnings, and I don't think it makes any sense to hedge now, given how overextended we are. For the indices on the equities, I don't think that there is much upside. At the same time, without any clear catalyst, I don't think that there is any clear puke, such as the one that we had in September 2022. Just because the markets are incredibly strong at the moment, maybe just because of liquidity problem, or I really don't know. But they are continuing to go up, and as Bryan said before, looking at the other indices such as the Russell, it's pumping hard, and even companies such as Nvidia that missed the earnings by a lot and pumped thereafter are still keeping out the gains after the earnings. And I expected after the yesterday's news that they are going to do a shelf offering of 10 billion that the stock would peak today, but it didn't. So there is a clear strength here, and what I'm looking for is either some very bad data, such as the jobless tomorrow. If we have incredibly high or incredibly low numbers, that's pretty bearish. Or we can just go this way up until the FOMC. And for the FOMC, I'm expecting either 50 basis points, which should have been the decision last time too, or 25 basis points with a very hawkish speech and an increase of quantitative tightening, because due to the treasury things and the liquidity injections from China and Japan, basically all the quantitative tightening this year has been completely offset. And that's clear in the equity market. It's absolutely clear where bankrupt companies can go up 50% in a day just because they may not go bankrupt, or it's completely insane. We are in pure euphoria, and valuation are completely overextended. And for many companies, Nvidia included, the metrics are even more overextended than they were in the peak of the bubble in 2021. So, I mean, I don't see much upside from here, but it's clear that we need something strong to have a strong downside. And something strong could be data, could be the Federal Reserve that brings back reality to the markets, could be some geopolitical event, could be anything that the market isn't expecting. And at the moment, the market is expecting the, well, inflation is not expected to be 2% in June anymore. It's a great thing, but most of the market participants still expect the inflation to come down substantially without a recession, which in my opinion is pretty difficult. And they're still expecting some cuts in 2024 from the Federal Reserve, which unless we have some big economic contraction, I don't see them happening, because there is no reason for the Fed to cut if nothing breaks. And if something breaks, it's not bullish for equities. So, yeah. And most importantly, looking at the dollar index that is used by algos to maneuver, to move in the market, is the biggest weight is the pair with the euro, so the euro dollar. And for the euro dollar to continue to go up, we should have the ECB that starts hiking more or longer than the Fed, which can't be done because of structural limits. I mean, the ECB can't hike as long as the Fed can before something breaks. That's just not happening. So I don't see much upside for the euro here neither. And that's more or less my view. I'm currently short Nvidia, short Apple, short euro, long dollar, and the other day I started a position on the stocks 50, short, of course. And that's more or less my opinion and my view for the upcoming months.
Yeah, I also remember that you keep a high position in cash, so that maybe when something unexpected happens, like I don't know, another shorting opportunity occurs or reposition may happen. We guess this is the reason also you chose, like me, to stay high cash, right?
Yeah, and also for risk management purposes. So I have less to hedge because the position are actually smaller in terms of overall NAV.
Yeah. I think we're gonna go with macro after Christopher, but first let's go with Ted.
Hi everyone, thanks for having me back on. I appreciate it. I'll share my screen here. So when we were last here, bear with me a second. Let me just get this dialed in. When I was last on 4 weeks ago, and we talked a lot about Goldilocks at the time. We just come off a really strong January. We saw the transition of China out of lockdown. We saw oil prices down. We saw inflation down, and we saw consumer discretionary high beta greater than 15% in the month of January. So things were going pretty well. I positioned myself pretty reasonably for that. I've been very conservative the whole year, but I was positioned for that move. So what I want to touch on today is what the hell happened to Goldilocks. Want to chat a little bit about my sense that crash risk is rising. So if I was somewhat bullish last time 4 weeks ago, I think I'm joining this den of bears today. And I also want to just touch on my positioning, which you'll see is very conservative and cash heavy right now. So anyway, I think one of the things that's important as a trader from my perspective is just to maintain a sense of flexibility of mind and nimble of position. I've gotten a lot better at this, not sort of being focused on a particular outcome, or if I think we're in a sort of a Goldilocks environment, I'm always looking for reasons why we might not be in that environment. And they came fast and furious at the end of the week. We met on Wednesday, the 1st, and by Friday, we had two massive catalysts that were really quite unexpected by the market, which really started to move us into a different environment. The first one was payrolls. We had 517,000. It wasn't a single person on the planet that thinks that happened, and I'm among those that still don't believe it did. But nevertheless, that was the data, and the market reacted. We also had ISM the same day, a couple hours later, and that came out super strong as well, 55.2 versus 49.2 in December. So suddenly we have two sort of immediate catalysts. And looking at the 5-minute chart, you can see this is a 5-minute chart on February 3rd. You can see that TNX, which is proxy for 10-year Treasury, immediately added 10 basis points and basically ticked higher. And then you saw at 10 o'clock when ISM came out, UUP, which is a proxy for US dollar, came out and immediately at 10 o'clock, jumped higher. So here we have we were in an environment where long rates were down, duration was down, and the dollar was down and retreating. All of a sudden, that's called into question. So fast forward to Valentine's Day, we got a CPI reading. It was a hot CPI reading, 6.4%, plus 6.4 on headline versus 6.2 expected. Core was also up 5.6 versus 5.4 expected. So that led me to conclude that, by the 15th of the month that, basically Goldilocks was over. And so I needed to one of the things that I'm experiencing during that period of time is losing money. And so when I start losing money, I start thinking about how to get repositioned for the market that I have, not the one that I thought I had. So that's taken a period of time. I'll share with you my positioning towards the end of this. At the same time, coming into the 16th, we're on the 16th here. OPEX was on Friday, the 17th. We had a lot of positive flows from Vixpiration the day before on Wednesday. Then OPEX was on the following day. We also discussed last time the positive flows that were coming from Treasury, basically washing out the effects of quantitative tightening, and those kept the indices higher. But with those starting to disappear, and full credit to Jem Carson, basically the Vanna and Charm flows, were coming off the table during this period of time, right up until yesterday, where we had some positive flows were gone, and now we're sort of out of that window of weakness as Vanna and Charm flows start to wear off into a big OPEX coming on the middle of the month. And also month end. So one of the things that I was observing on the 16th was on my indicators that TNX, again, my 10-year bond proxy, had shifted from bearish to neutral, but TLT was still holding on to bullish trend, which I had above 100. It was still bullish. And we also had, you can see, however, that shift took place in here where we had that bearish to neutral phase transition. And of course, now we're tapping 4% again on the 10-year. Something to think about. At the same time, we had the SPX. So I follow technicals as well. This blue line here was your 50% retracement level, and this is your 38.2. And what we had is another failure. We were banging against this 50% retracement level, trying to get higher on SPX. And on the 16th, we basically, made another try at it and failed, which led me to conclude that we might be in for a down move on SPX. And we have seen a slight down move. It's not quite what I thought, but it's still in play from my perspective. So at that point in time, Goldilocks is clearly off the table. I'm looking at, well, what are the catalysts? And we talked about that a little bit earlier today, about what the catalyst might be to tip SPX over. Looking at TNX above 3.9, clearly have got that. Strong dollar move, happening, but certainly not able to get above 106 yet. And of course, oil could be a big catalyst as well if we get up above 82. My opinion on that is that we've been pretty much embedded between 72 and 82, and we're in a trading range on WTI at any rate. So we're looking ahead at core PCE, what was going to happen coming into Friday on the 24th. Basically we saw again SPX having some challenges with and hedges seem to come off, and we've talked a little bit about how VIX can't catch a bid, and they seem to come off ahead of this number. This Cleveland Fed was forecasting a pretty benign inflation number, and then what did we get? We got another hot number. So that to me was sort of the death knell for the market environment that we've been in. We have basically an estimate of 4.7% was the actual number versus 4.3% on core PCE. This is the number that the Fed watches, obviously, and they've got a problem with the rates only being at 4.5 to 4.75 on their key inflation number, or their key interest rate number. So that's a number we're going to see. They're going to want to keep ticking that higher. They want to be above this 4.7 rate, and clearly they're managing market expectations to 5.25 to 5.5. Arguably, that's not going to be enough if we continue to see this increase in inflation. So Goldilocks clearly dead. And so that sort of, I was confused during this period of time. It's like, what is happening? What's going on in the macro picture? But to me, by the end of last week, I think it became really clear to me that we've got the risk of a crash rising pretty considerably. And some of the reasons for that is we saw a big move in the dollar. Dollar was up 1.3%. You can see here again this retracement levels where it was struggling to get back above this 50% retracement level on the full dollar move. This is the weekly chart. But then I had this Williams %R signal that signaled positive dollar. We certainly got good follow through on that. It really struggled at this 50% retracement level, but clearly has gone higher. Strong move last week. And of course, interest rates continuing to rise. We see that tapping into 4%, hitting the 4% wall earlier this week. And then I got a bullish signal on VIX at the end of last week on the weekly chart. And to me, that just was, okay, it's been pretty subdued, but here we go. So we may actually get some, if a catalyst comes, and it could be ISM on Friday. We've got that as a potential catalyst. Of course, geopolitical sits out there all the time. But to me, this was one of the key indicators that led me to believe that we could be looking at a crash situation, or at least a rapid drop. And of course, when we look at SPX, it's taken out that trend line. It took out, couldn't hold 41.55, has subsequently taken out the 38.2% retracement level. I don't have the exact level right in front of me, but it's taken that level out, and now we're drifting lower and into Bryan's 3,900 range, where there's a lot of put protection. I think if we can get below 3,900, There's not a lot of protection down below that. Everybody's pretty, buying put spreads, so we're fairly tight in that range. And so we'll see what happens if we get a breakdown below 3,900. That could be the drop, or it could be the catalyst that takes us lower across assets. So basically, what does that mean? I think it's been, for me, time to take cover. Crash risk is rising. Adding to dollar on pullbacks. I'm adding to shorts on bounces, which we haven't got much this week. I've added VIX-M, medium-term VIX to fairly cheap, so I'm adding to that on pullbacks, and bills, which is basically 3 to 6 month T-bills yielding over 5%. And why not be positioned there? So from a positioning point of view, this is my trading account. So I run a bunch of different strategies, but this is the one I pay the most attention to. I'm really, 73% cash plus UUP, so 78% cash. I have built positions in China, KBA, and CHIQ. I was ready to dump those until we got a strong print this morning from ISM Manufacturing on PMIs for China. But more importantly, the interesting number was the not so much manufacturing as it was non-manufacturing number, which was up big. And so CHIQ is really domestic focused and gets you some of that. FXI, which is not a ticker I've been using at all, is ADR based, whereas KBA is the A shares and CHIQ is domestic. I've also been long DXJ, and unlike the Nikkei, which has been sort of teetering between, I'll call it neutral trend right now, DXJ has remained strong, as has Mexico, which is EWW. And I also, CTA, which is a simplified trend following strategy. I've got a small allocation to that. It's positively correlated to the dollar, like everything else that isn't. And I'm also have a residual TLT position that I basically, because I keep thinking the recession's coming, that never comes. And so I'm biding my time here and probably will take off one of these positions. I think TBT is way oversold, but I basically hedged my TLT position with a TBT position, which is, twice that level. And then a small VIX-M position that I've started to build, a small SH, which is short SPX that I've started to build, and I will deploy cash there. I'm also hedging in my trading account, one of my other portfolios where I've been building a long gold position on this pullback. I've been buying and hedging with gold because I think it's going to work for us at some point in time. It is negatively correlated to the dollar, so that never really works well currently. But if we do get a geopolitical situation, or we do get some risk off, I think gold will do well. And then lastly, I put on an EWG short on Monday, and I will be adding to that as well. So that's what I've got.
Very straightforward. Very good.
Hey, Ted, I have a question. Yeah. Why are you buying gold?
Well, it has been bullish trend. It pulled back on my measures. It pulled back to neutral this past week. So I talked to Raphael about this. I've wanted to get a gold position. It went straight up, and I had about a 300 basis point position in my all-weather account. So I was selling into that, and I waited for this pullback. I've just been starting to build it. Why? Because I think ultimately this ends in a deflationary environment, and I think we get a bid for gold in that environment. And so I'm buying and hedging and trying to get to 1,000 basis points to 120 basis points in my gold position. But meanwhile, I've got 30 delta puts on that basically hedge my position.
Okay, thank you, Ted. Let's go to macro now with Christopher.
So, all right. Everybody's talking about Germany, so I'm happy that I included it into my charts. So, all right, I will share my screen. For me, there are basically two countries which do not make any sense, and that's Germany and that's Sweden. So both both in Europe. Sweden, I already elaborated on in the last macro talk. So basically, what we got now is negative credit growth in Sweden, which feeds directly into aggregate demand, which we can see a downward spiral if this continues with all the negative new orders data in the PMIs, and as well as the housing data for Sweden. So this one is still interesting. But for now, I wanted to look at Germany, because the recession probability is moving. On the left side, you can see the latest estimates, a 20-day moving average, as well as the normal recession probability. And you can see we're back at 40 or around about 60%. So historically, this is a pretty decent sign that something stressful can happen in Germany. What was the move, or why did the probability move? It's basically this relationship here. So I look at the spread between the 5-year bond yield and the 1-year bond yield, which I basically think of as a short-term financing proxy, as well as a medium-term refinancing proxy. So basically, it's the spread. You can see this in the what is it, blue line. So we're inverted, like every other spread if you look at Germany. And what's interesting for me is I also like to look at corporate bond yields. So and as well as the interaction between them. So I show this in the plot below. But you can look at the screen and see if they're moving together, like in, let's say, 2011 to 2015, nothing really happened. Everything's fine. Stock market is improving. But if they diverge, or if they bifurcate, something pretty interesting can happen. You can see this in 2000, where the spread between them entered a 2 standard deviation value above the mean. And as you can see this in the plot below on the red line. And this also happened in 2008 during the GFC. In the Corona crisis, it nearly touched 1 standard deviation, but currently we're back at 1 standard deviation. So what does this basically mean? Recession probability is going up. Something is happening in Germany, and this has multiple reasons, as we already know. But I find this quite interesting, because the spread keeps on getting volatile, and as well as the recession probability. But now looks like it's anchored, and corporate yields are also rebounded, which decreased in the last weeks. So I think this is another positive sign for an ongoing recessionary move in Germany. If you look at growth probability measures, on the left side, you can see the relationship between growth probability, which is also back up at being at 90%, or 90% for a fall in growth probability. And this shows a great relationship with index returns year over year. And if I take these 2 numbers and let them run through a Bayesian regression with 2 confidence intervals and a mean output, you can see on the right side that in year-over-year terms, we're above the 75 confidence interval based on this analysis. What also is quite interesting is that everything is kind of stable in year-over-year terms. If growth probability is only elevated and recession probability is pretty low. But once recession probability rises again, everything can get pretty chaotic in markets. So you can see this during the Corona crash. You can also see this in the latest data estimates. So you can see that the lower and upper bound, as well as the mean bound, they're moving quite frequently. They are showing a massive volatility, which I would think should already, or should basically move into markets. So I am really bearish on Germany again. In the last 2 weeks ago, I said Europe could hold up pretty good, as well as Germany, because equity prices and the overall picture was pricing in a real growth scenario for Europe as well as for Germany. This was kind of true, I guess, if you only look at equity returns. But if you think that they basically signal different things, and equity returns are not the best predictor for overall economic output, then this one becomes quite interesting again, in my opinion. So if this EBG or the DAX, if it corrects and shows some decent downward trend momentum, then it's a pretty good short, in my opinion. And as well, when we look at some macro data, so this is a simple economic feedback loop. So it's a dynamic system. It's based on aggregate demand. So you can see in the image that it starts with aggregate demand. You see the relationships. The dotted lines are a negative relationship, the others are positive. So this simple real aggregate demand model basically takes into account inventories, which build the basis for production targets as well as capacity targets, and they all interact together in terms of production capacity as well as capacity utilization rates, and they feed into real GDP. You can see this pretty good in the data, which I will show later. So this does not take into account any money movement, not any fiscal spending, not any money creation. This is simply aggregate demand and the interactions between inventories and overall capacity utilization. So, and this works pretty good with in countries with a decent industrial production, and you can see the relationship now. So if you can see this chart, it's quite messy, but the blue line shows the 1 quarter difference in EFO business area manufacturing capacity utilization. The yellow line shows shows industrial production, and the pink line shows real GDP. So basically, this is the assessment for that they show a quite significant relationship. So manufacturing output determines economic output. But it's, in my opinion, it's something like a true definition. And this is also useful if you want to achieve long-term economic growth, because this is where most of the capital sits. And if you use the feedback loop system for aggregate demand, we can use the 1 year difference in the finished goods inventory, which is usually in percentage points. So take the 1 year difference and we plot it against industrial production. So, and this shows a pretty strong relationship, negative relationship on the correlation coefficient basis of minus 0.65 and R squared of 0.42. So it's a pretty good relationship, in my opinion. And what we can basically see is every time this thing moves, the goods inventory moves into positive territory, or massively, as we can see in the GFC, and as well now, industrial production should decline massively, unless government spending is pretty significant and they create something like consumer demand by using checks, putting it into the deposits. So based on this indicator, we should expect industrial production to fall significantly. Another relationship is that that inventory, the difference of the yearly inventory, predicts with something of a 1 to 2 months lead capacity utilization. And this is a neat cycle, in my opinion. You can see inventory cycles. It's something like a wave function. and the relationship is also pretty decent. So correlation coefficient of minus 0.78. You can see this in the upper right corner. And what this basically says is that we should expect capacity utilization to drop another 10 points based on inventory cycles. This is quite a significant number if capacity utilization drops because of the significant relationship to real GDP. And you can see what this picture might look like if you look at the square on the bottom right end of the chart. So it's basically at minus 7% real GDP year over year. If we use the relationship, which is also pretty good at a correlation coefficient of positive 0.8. This is basically the feedback loop, which we can also find if we look at real economic data. So it's, in my opinion, it's pretty good indicator. Given all this information and overall information about what you guys said about Germany and taking short positions, I find this is a very attractive short, in my opinion. The data is pretty bad. Retail sales are pretty bad, which you can see here. So this is another Bayesian analysis, regression analysis with upper and lower bounds. So lower bound signals also a minus 5% year-over-year real GDP with a retail sector recession probability of 100%, basically. So the consumer is pretty bad in Germany. You can also see this in the consumer confidence numbers, which rebounded a bit, but not to a level that suggests any growth output, unless we see a massive fiscal spending and government creates demand for the consumers. So short thesis, in my opinion, is still going on in Germany. Another thing I would like to talk about is the USA regime data. So on a 3 months difference of the year-over-year growth rates for GDP and as well for CPI, we should still be in disinflation. Remember, this is a 3 months trending basis, not a month-over-month change. But what is quite interesting is if you look at the right side, you can see the uptick in stagflationary probability on the right side here. You can see this did rise by 15% in the last week. So this is quite significant. And this is basically the argument what MNT is saying, that raising interest rates as well as Fed funds increases government spending by interest payments, and bondholders get additional capital by holding bonds to a certain part. And the argument there is that this should reflect in consumer confidence as well, positively influence aggregate demand. So if you look at in my opinion, 2023 is quite interesting in this regard, because we could see a clash of who's right with inflation. So is raising rates inflationary or not? Can you find any data that supports this with the time being and the last 3 months or so? There could be an argument that raising rates could be inflationary. This would also explain why what Bryan said, the price movement is reflationary, with bonds interest rates up as well as stocks up. So who knows? Or if neoclassical economists are quite right that by raising rates, ISLM will decrease money supply as well as crash demand, and therefore decrease inflation. So this is still interesting in my opinion for 2023. But nonetheless, for me, it's a risk-off period. Still, we're getting no growth. Real growth as well as reflation probability is really, really low. Nothing changed in this regard. And what is quite worrying to me is the housing market data. So housing starts in year-over-year terms down significantly, building permits down significantly, new home sales also down existing home sales also down, and the overall home sales index is also down significantly. And even if we are looking at this at first difference, on a first difference basis, this thing, the level is still pretty low. And in my opinion, this will also decide whether we are going into a softish landing or a really hard recessionary landing. And what is also quite deflationary, in my opinion, is the spread between mortgage rates, 30-year fixed mortgage rates, as well minus the 10-year bond. So this has a pretty good correlation with disinflationary environments. And if you look at this, where I think it's basically like 3 standard deviations now above mean. So yeah, this is also quite worrying. So to sum it up, it's another bearish chart deck. So yeah, let's see what the market brings.
Yeah,
Christopher, I have a quick question for him, Raph. So, okay, so you were pretty bullish 2 weeks ago, and you just said a lot there. Like, what is like the main data that has changed your model in Germany to now flip mega bearish? Like, what were like the big confluence of events? Just like a couple of key prints that now have flipped everything.
It's basically the difference in corporate bond yields. So in corporate yields. So they raised in the last. They got up on a or still up on a 3-month difference basis. So I'd quite like to look at it. But if I take into account all the equity factors and how they performed, so this is still a growth-ish period, but it's only based on equity factors. So now the decision is basically, are equities right or not? How do you think the market is the perfect forward-looking indicator for Germany, or you think that there's some growth dislocations which can be shown by interest rates as well? So
okay, so during the last meeting, bond yields had started going up, but they weren't completely ripping yet. Basically, at that point, equities were still strong. I mean, CAC was about to get to its all-time high. The difference between the equity performance and the bond performance was understandable, but now corporate yields have just gone too far, and that's like the main trigger for you.
Yeah, for me it is. Also with respect to that, it's the refinancing problem, in my opinion. So you can only take rates up to a certain amount, or to a certain amount, and over a period of time, because interest burdens are keep rising to a point where they're not longer sustainable. This is not especially a problem in Germany right now, because private credit is pretty low if we compare it to Sweden. But the market dynamics, they show this pretty clearly. You can see this in the first slide. So the spread continued to grow on the lower plot. This also increased. This is basically a signal for me. Okay, growth is falling, and recession probability is going higher. If we use it as a proxy for refinancing, then this is a key data point for me. You can corporate yields, they have a, if we look at the 3 months change to the 3 months equity price returns, the correlation is pretty significant. It's like 0.5, positively 0.5, if I remember this correctly. This is pretty crazy. They determine, in my opinion, it's trading. They trading like corporate bonds. So equity market trading like it. If this spread continues to widen, recession probability is going up.
Got it.
Okay. I certainly would like a puke in DAX. That would be nice. So yeah, so yeah, firstly regarding macro, so yeah, I agree with a lot of things that were said by Christopher. Like basically, he was right. It's the equities that are pricing like crazy stuff in Europe, or the impact bonds are gonna have later on. I mean, at some point, it's just impossible to have this kind of prices in Europe, and the yields keep still going higher. Anyway, let's go to to the usual signals. Screen share up. Okay. So like like most of you have seen, so yeah, the 2nd of February was yeah, big capitulation day. Actually got the sell signal on that day, so that was nice. And since then we've had volatility of US 500. I'm looking at cash most of the time. I find it more accurate to monitor volatility. We've had volatility actually spike and go above what I consider my trade level. So this is a good sign. The issue so far is that we've been unable to break trend. And you can actually see that also in my fractal range, where you have GSPC, so S&P 500, which is actually neutral. So no trend break so far. The last time we've had this kind of battle was in December. But volatility trade had not gone down that low. So the chance now are much bigger that we get a breakdown. I'm actually agreeing with Matt regarding the bounce. The reason is that I got a trigger on my inverse ticker 0 minus SPX. I monitor this kind of tickers. I've been getting sell signals on this one, so meaning a bounce is coming. And usually when I get this kind of signal, sell, what you get is at least a retest of the area in that I consider the trade level. So bounce toward 40, 50, 40, 90 would not surprise me. I'm actually waiting for, I already deleveraged at 39.70, but I'm waiting for another confirmation here. It's another signal that needs to trigger to unload some more and confirm that we are getting the bounce in SPX and then reload some more shorts in this area. So I'm thinking by the end of this week, I would guess the sell will be confirmed. I will unload, and next week we're gonna have the mooners again, probably trying to chase maybe a retest of a break of the previous high, which I don't think will happen. So I'm gonna try to reload in this area. So that's basically my setup for now. If it keeps going and I keep getting sell signal, of course, I'm not going to do anything. I'm going to ride it, but that's not my thinking currently. Yeah, for Europe. So Europe has been very resilient. So you can see here, for example, the CAC, any sell signal was ignored. I mean, when this kind of stuff happens, it means they are buying like crazy. So you can do nothing but wait. It's held in December, like the US. It's held trade and trend, rebounded and went higher. We started to see some interesting signal with volatility trying to raise above trade, but no confirmation yet. So I certainly would like to add to CAC and DAX. I've been very patient. I unloaded I don't remember exactly where, but I unloaded somewhere here, and I've been waiting to add back, hoping for a big crash to get in Europe, which I expect will happen. Germany looks the same. I mean, it's basically the same thing as CAC. You can see December tried to break, held, getting sell signal, ignored, still going higher. I've seen data regarding the companies purchasing their doing buybacks in Europe, because as far as I know, we don't have the companies don't stop to do buybacks, and the buybacks have been insane last year and still going on this year. So my guess is this could be the reason why European markets have been on a rip. But yeah, I'm waiting. Somebody asked in the chat about IBEX. So if you check IBEX in my fractal range, actually it's very bullish, sorry. So you can see here, downside, upside, fair fight, and long-term upside, downside, also fair fight. Earth is quite strong, but I checked the minimum where usually trade goes before you get a sell-off in IBEX, and we are near. So basically 1.3 is the data that you usually get before you get the big sell-off in IBEX, and you can see trade of vola of IBEX is near there. What happens there? I've addressed this regarding gold, silver, etc. in the past. What you get is actually volatility will spike, because at some point volatility cannot go below 0, right? And being compressed by trade, at some point vola will explode. So we are getting very near for IBEX. I mean, taking a short here, I don't know macro for Spain, right? But looking at the volatility profile, I mean, taking shorts here is would be fair game. I don't expect this thing to last much. So it's the same thing as with the CAC and the DAX. I think we are very near. Now to the big guy, Dixie. So we got the move that we were expecting, right? So volatility on DXY was crushed. We got the matrix also signaling the same kind of trade. And now we arrived in the 105 area, and I can see matrix is now turning. So now the big question is, during this cycle down for matrix, it's one of my indicators to watch momentum. During this cycle down of matrix, where will DXY be? So ideally, what we want to see is DXY holding in this area, at least above a trend, so above 102 level. But we don't want to see a breakdown, because if we see a breakdown while matrix cycle is completing, that would mean that this here was not the bottom. I don't think it is right now, but I'm willing to change my mind. So I'm gonna wait for matrix to confirm the cycle is over, and then I will start to add aggressively to dollar and to short Euro USD, because of course I'm watching Euro USD the same way I'm watching dollar. You can see actually the same thing happen on matrix also for Euro USD. It's volatility receded, and now we are starting to get volatility of Euro USD to go down. So what happens when volatility of an asset goes down? The asset goes up, right? So I'm waiting for matrix to complete the cycle on daily. I'm waiting to see the volatility behavior when it will reach trade. It's not how to say, it can happen that you have the asset going just above and getting rejected. So for now, this would be my my setup, but I need to wait for it to go higher to see. Yeah, so gold, platinum, and silver. So regarding my macro thesis, so I'm waiting for the inflationary puke to take place, and the portfolio I would like to build for this inflationary puke to come is long precious metals, and have some long US oil. And the problem now is that we are not yet at the inflationary puke, and gold is neutral, platinum bearish, silver is bearish. So I'm looking to time this right. I still have small positions in all three, but I'm not going crazy yet. You can see here that the matrix is doing the same thing as Euro USD. It's basically US dollar trade. So it's nothing macro, it's just US dollar trade. So I'm waiting for the same thing. I will wait for the matrix to go higher, and I will reassess. Will we get a bounce in volatility of gold and then gold to go down even more, or will we get volatility to crash? So that's a big question. For now, of course, I'm thinking volatility of gold will keep going higher. As you can see, we are very far away from the max vola that the gold can print. So we have the same kind of price action we've had in beginning of March 22. You have volatility rising. I would expect a retest of trade and a spike. So that's my thinking right now. When we get to these kind of levels, I guess I will start to go bigger. Ideally, I would like to see this kind of price action. We've got a reclaiming trend and trade, but we are not there yet. Platinum looks the same. I've had buy signals in platinum here, but considering what I see in gold, I'm still waiting. So you can see here, matrix is rising, but my expectation is that it's gonna complete here and then go down, and price of platinum should go down. Trade of vola of platinum is still very low. We have much more room to go, and I would expect platinum to either chop or go lower. Silver looks the same. Okay, same. You can see here, its volatility craziness is gone. We should get volatility to go down. And then the question will be what happens there. I would guess we go to somewhere here, then go down, and then maybe we get a decent buying opportunity there. So precious metal is really something I want to buy heavy, because it will serve in the next two phases of this 2023-2024 crash, because precious metals outperform in the inflationary panic, but they also outperform in deflation. So of course silver a little less so, but they will perform in the next macro setup that I believe we will face. US oil is more for the puke, for the inflationary puke. It looks actually much better. So it reclaim trend, and now I would guess, I think we're going to get a breakout here. So we are near. I don't know when, but we are very near. So what I do is I accumulate when we go around 74, 73, and I sell some when we go around 80. Ted have mentioned this range so far. I think it's a good bet to do this, as I don't expect the deflation trade to happen before late summer. I mean, I'm not seeing deflation being relevant before at least August. So that's why I'm not quite worried about trading oil on the long side. Also considering that it outperforms greatly, energy outperforms greatly in inflationary panic. So yeah, and then get rid of it later on. That's another thing I'm looking at.
About Bitcoin, Raph.
Yeah, Bitcoin. What the this is mystery to me. I mean, I don't understand casino, right? I mean, this thing respected my range pretty good, pretty good. It's not the right setup in a trading view, but I've mentioned the range based on vol, and basically you have one around 25 and another one right there around 23. It's just trading there, but the next one is around 20. So my guess is at some point it's going to go. Probably, I would say when we get next week the fake dip that I think is going to happen, and then the sell-off probably to this kind of area. So my guess would be there. But yeah, it's holding quite nicely. I don't know who is holding it, but yeah, they are doing their job quite nicely. Yeah, I think yeah, VIX, of course. Sorry. So VIX, yeah, I'm amazed by, again, every 2 weeks I say this, but I'm amazed by the fact that we are not in the 30s. I don't know how they do this, but we are not there. For now, trade is still oriented to the downside. Vola is still oriented down. I don't see any reason to, for now, to unload aggressively on the short side. Of course, if a volatility of VIX reclaim trade, it's going to be another story. This would mean that VIX is going to get crushed, but we are not there yet. I would expect a spike first, and then maybe another bear market rally, and then the final puke that I'm expecting. Yeah, that's it. That's it for me. Stop share. Okay. Now I'm gonna check the questions maybe from the people. So they mentioned IBEX and already.
You're on mute, Raph.
Yeah, so question about yields. Emergency rate hike on the cards or just higher rates at the next FOMC? Okay, so yeah, I don't see for myself, I don't see the emergency rate hike yet. So I've tried to study the long-term correlation between bonds and stocks, and because I've seen that it's quite reliable to time the macro shift during this bear market. And from what I see based on the long-term correlation, the macro puke should happen based on correlation again. And if, I don't know if I'm right, we're going to see somewhere end of April, beginning of May. So I would not expect the emergency rate hikes to happen before that time. So I would guess maybe plus 25 or plus 50 basis points at the next FOMC meeting. Anybody else?
Yeah, I would say the same. I think they just hike another 25, just dragging this thing over the next couple of months. And yeah, they don't look at credit, in my opinion. So why not? Raising rates, fight inflation. Let's see how this ends up. I think it's interesting.
I agree with Christopher and Raph in that I think they've got a credibility issue. They already went to 25 from 50. I don't think they're going to go 25, but I do think they've got summary of economic projections, so the dot plots will be out with the March FOMC. So I think what they'll be doing is they'll be managing the rate market higher. They've got to get up above that core PCE rate. So they've got to take it to at least 5.25, 5.5. And I think they'll manage expectations higher, and they'll just say, we're just going to keep rolling 25 basis points at a time until we get to where we need to be. And they'll move the market that way.
Matteo?
Yeah, I think that's what's really important for the next FOMC. It's the quantitative tightening rate. I mean, they have a probably credibility issue after the last hike because it was way too low, and all the data that came after the FOMC was way too hot. So that was a policy error, and all the speech that was very, it wasn't dovish, but it was very soft. It was something that shouldn't have been done. So I think that even if they don't hike 50 basis points, what's really important is that they need to shift the focus to the quantitative tightening and say something like, we're gonna continue or we're gonna increase the rate, because that's what's really important at the moment. The market already priced in the higher for longer. So having 25 basis points and the shorter term, lower federal funds rate terminal, and or having the 50 basis points and having state terminal, it's really not much of a difference. The focus of the market at the moment, it's really much on liquidity and quantitative tightening is the solution for that problem, in my opinion.
Bryan?
Yeah, Jerome was just a absolute disaster at the last meeting. He was so soft. He didn't want to fight back about anything. He thought he had like disinflation, inflation was going to go down. It was all going to be great. They were to get the soft landing. He was feeling all giddy about Goldilocks and his soft landing and all that. So I don't know what he's going to do at the next meeting, but the risk is completely to the hawkish side, and they just started pricing in the potential of 50 bips at the next meeting. You're up to now, I think it was 27% this morning, potential chance of what the bond market's pricing for 50 bips at the next meeting. I don't know whether he does it or not. I'm not sure, but I think like between now and FOMC, which is we still have to get through a jobs report, we still have to get through another CPI report, we still have to get through ISM services. There's like endless catalysts now until the Fed actually does this at the end of March, and so there's a lot of trading to do between now and then whatever Jerome actually does. And so, you know, if all goes well, I mean, the data has just been coming out completely in the bear favor. Like I haven't seen a single data point that like hasn't been great for the bear case. So if that keeps going, I assume stocks, you know, eventually fall on their ass at the end, right into FOMC, and then you get the classic he hikes 50 or 25 and then the market rips. I mean, I think I can see that kind of scenario happening, but he's got a problem because he's completely screwed up the last meeting and he hasn't really come back out at all and changed that. So I think he has to be more hawkish. The market is currently, the bond market says he has to be more hawkish. And so I think he's going to be more hawkish. But I don't think you have to do an emergency rate hike because we got a meeting in 20 days. So
Yeah, I mean, emergency rate hike. I mean, I don't see the guy come in right now and say, okay, I'm raising by 200 basis points. I mean, we need inflation to just rip much higher first. Christopher, actually, I have another question regarding, for example, what Matteo said about QT, because it seems that the ECB is quite behind in terms of QT and that they are starting to get serious actually from today, no?
What I read today is that they are going to be, they're trying to do that, but they're also trying to get inflation down, and they will come up pretty hawkish. They will raise rates. I know this Miss Nagel said that they need a massive rate hike in the next months to get down inflation to where they wanted it to be. But overall, as well as for the US, so labor market data is still pretty good. GDP now, quarterly growth is pretty good. So if they use their policy analysis and their DSG models, it's basically what they need to do. So it's not the case that inflation expectations going to be unanchored. And with the additional rate hikes, what I think they forget is that they are in a pretty deep deficit. So even if they're raising rates, this will most likely neglect some changes in quantitative tightening, because if the government goes into deficit, they're actually creating money. So this has been shown by Deutsche Bundesbank as well as by the BOE. So I think they're trying to do it and to get some changes in the wealth effect, but this has not been shown in the stocks lately. If they try to lower the balance sheet, so I don't know. I think economic data is pretty weak in all of Europe. So that's my base case that this will drag down economic output.
And okay, one last question, then we can wrap this up. Eric was mentioning, so he's saying my read on signal on the DXY is that it's bullish trade and trend, and its correlation is largely is largely over. How does that confront with your views? So I've addressed dollar, but maybe you have different opinions. I mean, do you think it has bottomed, or do you think it has not bottomed? And what are you looking for to confirm it has bottomed?
Who is the question addressed to, Raph?
It's pretty much to everyone. He said y'all.
Oh,
So
I mean, I think dollar's bottom for sure. It bottomed on February 2nd, bear capitulation day. So I mean, it's clear. But I mean, for continuation, I mean, I love the fact that it's fully transitioned to bullish trend in MFR now. So check on that. Last meeting, we did talk about how the excess long-term upside in the range in MFR was capped. That started to open up a little bit, and the downside's opened up on gold too, which was nice to see this week. So I think there's some room for it to go higher. Hurst exponents are strengthening on it. So on a day like today, where it was red, that's not that great into tomorrow. But then, you know, I could see unless we absolutely puke tomorrow, which would, I think, if stocks puke hard, like the dollar has to bid. You're not going to get days like this very often, where stocks down, you know, dollar down. But we could follow through tomorrow with dollar down because of what the Hurst says. Or it could weaken. Recently, dollar Hurst has been weakening on down moves or strengthening on up moves. So we'll see if it weakens again in the morning. But like Friday's ISM services, I expect you get another bounce in the dollar as you did this morning off of manufacturing, and then the Hurst carries it higher. So I think the dollar trend is firm, and then it strengthens the inverse correlation with stocks and bonds too.
Anybody disagrees, or everybody agrees on the fact that GXY has bottomed?
My view is that we're in no man's land right now, and we really need to, we need to firm here, and then we need to put in a higher low and move higher. I'd like to see a close above 106 and change in order to sort of confirm that next leg up of the dollar, but it certainly looks like that's the case, but subject to the price action. You've got the strong euro happening today on the China data. That was interesting. You know, a lot of hawkish talk coming out of Europe, and that, you know, obviously, I think the perception has been that Europe has further to go than does the US in terms of the inflation battle, although that's becoming more and more suspect. But that strong euro is really, you know, pressuring the dollar. I was impressed with how it performed today, meaning that it was down maybe 6.7% and closed down, you know, 4.5, 5. So it's behaving well, but let's see. I'm not willing to say the bottom's in yet.
If I can add something related to the dollar, I think it's more a matter also how the euro will kind of behave, because if you think about the current structure of how we are positioned in Europe, we have, first of all, if you check the like Euribor against SOFR, in Euribor we are pretty much not pricing it any cuts in 23, which is kind of supportive for the euro compared to the US, where we have still some kind of 10 or like 12 basis point of cuts, which can be kind of supportive. But the battle with inflation for the European Central Bank can get quite tricky, for my opinion, for two main reasons. The first one is that they can go and do QT. They started actually today with 15 billion a month, but at the same time, they didn't have until now any kind of issue with spreads, which is a positive thing, Usually when you have widening in peripheral spreads like BTP Bund or Bund against OATs, it tends to be quite bearish for the euro. And until now, we didn't have it. But with the hiking they want to do, and also this kind of inflation that I'm not so sure it will go down as fast as everyone expect or was expecting. I think the numbers we had in the recent days will had an impact in the market. It's not easy to be bullish on euro and say, okay, I want to belong the currency. Of course, on the other hand, I think we will get just some kind of range bound action and then move to the next stage. But like for the signal I have, the dollar is kind of in bullish trend until my level is around 103. If it stays above that, I'm kind of fine. But still, I think we are kind of in a choppy territory, and we will have to see what happens.
Okay, guys, perfect. So we will do the traditional bet at the end of the show. So last time we had two bets. One was DXY bullish or not, and I was the only one who said no. I thought it would remain neutral. So, but everybody else said bullish. Good for you. And the other was how high the VIX would go, and so Chris and I were the closest. We said 24, and yeah, I mean we didn't go to 31, unfortunately. Maybe by Monsen, right? So for the bounce, for the next bet, I would like to ask: do you guys think we get a bounce above 40.80?
No.
Yes or no?
No.
So no for Bryan.
No, absolutely not for me.
Okay, Matteo, no. Don't be afraid.
No, everyone is going for the no. So, but I tend to agree. I'm for the no.
Okay.
Yeah, I'm also going with no.
Mm-hmm.
No,
Dead? No? Okay.
sorry.
I need to double check just to be sure. So 39.80. Sorry, 40.80. 40.80. Yeah. Yeah, I'm going with the yes, actually. Okay, going contra again. Didn't bring luck last time. Okay, guys, thank you very much for coming in. Thank you to Matteo and Andrea for their first time. And so it's a regular thing. So when you have time, just pop back in. Yeah, I hope you enjoyed it. And sorry, Vi was not there. He's traveling back to Lithuania. He will be back. He will be back on in 2 weeks, and I probably won't be there because I will be traveling in Eastern Europe, so I will not be available. But anyway, thanks a lot, guys. Have a great night, and thank you for the audience for taking the 2 hours to watch us talk about the market.
So.
See you. Okay, we're good.